Hi guys, welcome to the seventh part of the market profile educational series. Now in this part we are going to talk about A, volumes, basically the high volume area and the low volume area and its importance, and the market development process. Now in the market development process I'm just going to take you to the four stages of the market which are well defined, and I'll just give you insights into how profile look into those stages. Alright, so let's begin. As we have touched upon before, that market is basically where it's an auction process. Especially stock markets move. There's a large amount of human sentiments involved, and sentiments do determine where the perceived value is for traders. So essentially what market reflects is the value trading aspect in it. And if a buying trader thinks that the value is low, he'll buy. The price is low when compared to value, he'll buy. Vice versa for the seller. Now during this auction process, what happens is market enters a state of balance and imbalance. In the balance stage, most of the participants agree upon the value. That is where the market just rotates in a given range. It's balanced. In an imbalanced state, the market participants don't agree with the perceived value. One of them definitely thinks that the perceived price or the perceived value is low, and he tends to take the price higher because he thinks that the underneath value is high. So this is how it shapes up, and this is what determines the market development stage. Now usually what happens is the market moves from balance to imbalance and imbalance to balance. This is a cycle, continuous cycle which goes on. What happens is most of the traders try and weather out the balanced phase, but then they get stopped out. They get so many whipsaws that it's so damaging psychologically that they completely get out of the market. And that is when an imbalance phase starts. That is a trending phase. Now seeing the trending phase again, they tend to jump back again into the market, not knowing that again they are entering in the balance phase. So this is something you must know, that unless and until you can ride out the balanced phase of the market, you cannot profit in the imbalanced state. Alright, the cycle of balance and imbalance has four stages, that is accumulation, the trending phase, the distribution, and the trending down. I'm giving you an uptrend cycle here. Now if you see during an accumulation, there will be a lot of neutral days, non-trend days, then the normal days. In these days you will see that the value area will overlap a lot. There won't be a sustainable trend. Whereas in trend days you will see that the value area confidence is high, the trend is good. There will be a lot of trend days, the normal variation days. In distribution days again you will see that the value area trend will stop. The trend will stall. A lot of value area overlaps will happen. There won't be any particular trend. Neutral days would happen which reflect uncertainty. Normal days, the non-trend days, a lot of rotations will happen, and then again a trend phase will follow. So this is just a cycle. Now in ideal world four stages may happen, but in real world sometimes what happens is you may see accumulation, trend, and direct trend on the downside. I'm giving you a long-term, longer side cycle, buy side cycle. You won't see price distribution that much in the third phase. You'll just see stage 1, stage 2, then stage 4. Sometimes it happens like this. So be prepared to adapt a little. Textbook things usually don't happen in the market. But out of 10 times, if you see these four stages play out, so these are equally important. Now during accumulation again what you see is, again I am giving an example of an uptrend, that the news will be terrible, fundamentals will be poor, a lot of uncertainty will be there. This is where value and price overlap with each other. Value area overlaps with the previous value areas. There is no trend. Then in trend the prices starts to move up. The value area traders still feel the value area is down. They don't believe that the value area has begun rallying. It's begin to catch up with prices. This disbelief further fuels the rally. In distribution now, a lot of participants start thinking that the trend is here to stay. They jump in not knowing that they're entering on the wrong time, and again the trend phase follows. So these are the four broad mini cycles which happen within a large cycle. Alright, okay, yeah, now we come to the volume aspect. This tutorial is relatively very short because it does not contain things that are directly applicable to market profile, but these two aspects that we are discussing, that is the stage analysis of the market and the volume importance, they form an integral part of market profile analysis when we discuss our framework. Okay, so now why are volume areas helpful? See, volume areas basically can act as support or resistance depending on where they are. They're also used, as to gauge market sentiments. A spike in volume reflects something else, whereas low volume selling reflects something else, high volume selling reflects something else. So it basically conveys the sentiment of the market. Now during counter trend rallies or major rallies, you will find that the high volume areas and the low volume areas act as support and resistance. That is why when you do your homework before the market opens, it is very important for you to write down which is the previous value, high volume area or the low volume area, and what happened previously on that. Okay, so basically we are just going to discuss about two kind of volume areas. One is the high volume area, and the second one is the low volume area. So see, why will a volume be high in a particular area? If you think deeply, you would know that whenever a price forms or spends basically a lot of time in a particular area, the volume develops. So that becomes a high volume area. A lot of price rotations have happened, a lot of exchanges have happened, and during this phase both buyer and sellers are present, and that is why a balance kind of forms. High volume area, remember, there are it's an area where a fair price transaction happens, and hence in non-trending markets most of the times you will see that the price is being attracted by the high volume areas. Okay. Time cycle wise, if you see, when a price spends a lot of time in a high volume area, it is bound to come out of it. So instead of running away from bracketed and range bound markets, I think traders should participate in a range bound market, because sooner than later that market will end and a trending phase will emerge. Alright, so this is contrary to what is written in most of the books, but this is true. If you cannot ride out the range bound market, you cannot with 7 out of 10 times you'll miss out on the trend. It is just how market behaves. So yeah, one thing I want to make clear: when we talk about high volume area, do not draw out the highest point in the volume and mark that price to the tune of 2 decimals or 1 decimal. No, high volume area is usually a zone, given to take 20 30 points. Alright, so be flexible in that approach. Now there's one more thing. The high volume area at times can signify the trend of the market. See, if you see the market gapping up and it doesn't visit the high volume area and it keeps going up, you should take into account the fact that from bracketed market or range bound market we are now moving into trending market. When the price does not come back to the high volume area, it is a strong indication that something has changed in the market and that range bound market phase is getting over. Okay. Most of the time when the prices are rotating, you should know that the participants are building positions for the next move ahead. That is why you see that range periods are so long. It is long because most of the participants are preparing themselves for the next phase. Alright, now this should be clear. So now let's say that a way to look at high volume area is this. So let's say you have a high volume area. The price eventually takes out the high volume area, it rallies up. If it retraces back to the high volume area, that becomes a good entry point that can be used as a strategy. Alright, I think I have put out an example of this. Yeah, so let us see. In this graph, if you see, this is the highest volume area recorded. Now what happens is, next day when the price opens, the high volume area of this zone, it opens above that. But then what happens is, price tries to feel for the market out here, somewhere below the high volume area, and immediately bounces back and it rallies. Okay, now some of you might ask, why are we taking this high volume area, why not this and this? The simple answer is, when you're plotting a volume profile, what you need to look at is, for a high volume area node, which is the region where the highest volume activity has happened. Okay, even if you, let's assume, even if you don't agree with this and you want to take this as a high volume area, what you need to know is that the price opened here below the high volume zone. It kind of formed a base, and once it came out to this bar, that means it has crossed this high volume node, and hence you can enter. Alright, and look how strong the trend is. The prices are just not falling back to this area. This just reflects, and look at the WRVs here, it just reflects that market is trending higher. Alright, so this is where volumes are very important. Okay, now just let's move down to low volume areas. Now again, if you think logically, why would a low volume area develop? A low volume area develops when the market does not stay at that price for a long time, it just moves past through it. That is low volume area. That tells you two things. One, let's say a market is shifting from 5900 to 5950 and it happens in 10 minutes, and between those 15 points there is low volume. It tells you, number one, that the activity is so low that the traders who have entered the market perceive the value to be so higher that the rotations have not happened in those 50 points and the market has just moved up. So that becomes a very strong support. Okay, and it tells you one more thing. Let's see, high volume area will usually form when the price spends a lot of time in that area. That means we are in balanced market. But when the price is quickly moving away, leaving low volume tails, what does that tell you? It tells you that market is moving out of range bound market and it is now entering a trending market. So a low volume area can be termed as a trend change indicator. It represents rejection of that price area, and the market just moves up from there. I hope you're getting what I'm saying. Yeah. Now usually, low volume areas can be identified. Either you make a volume profile, you can easily get through that, or if you look at the gap ups or the price excesses or the tail, or the range extensions, these will be low volume areas. Okay, that is where they get helpful. Let me see if an example. Yeah, this is a 3D example. Okay, so let's look here. The low volume areas, if you identify it, is this and here. Now why we are taking this and not this? Look, the price is opened here, it stayed above here, it's closing here. That means we are getting a long selling tail here. Okay, when we reach this bar, we are continuously above this low volume area. That means we are above the support. Now what you have to see is that this bar has also failed to close above this high volume area. Similarly, this bar, this bar, this bar, these bars have failed to close, but they are also above this low volume area, which signifies support. So then you wait for further signals. The moment these three bars develop when the prices move down, you know that now the market has a low volume area which has been rejected strongly. Okay, now you take the next day. This is in continuation. Market opens. It opens above the range that was plotted here, but it is below this low volume area. look, in this candle, and this candle, market has tried to probe back into the low volume area, but look at where the prices are closing, nearly halfway, below halfway. Okay, and in today's session this becomes the low volume area. Okay, this is irrelevant at this stage. It is irrelevant because price has not been rejected here, price has been rejected in this low volume area. I hope you're getting me. Now we have two sets of low volume areas, one is this and second is this. So this band here and this band here becomes the low volume areas. Now see what happened next day. Market again gave a strong green candle. It tried to poke into the low volume area of previous day. See what happened to the next candle. We got a strong close. So we have now got three rejections. Now when this red candle closed, you will see it has also closed below the high volume area of yesterday. I hope you're getting what I'm saying. So what rejections are we getting? We are getting rejections of low volume area. We have also got a rejection of high volume area. Now when you combine this whole picture, there is only one way the market is going. It looks good on an example, it's difficult in real time, but if you practice this basic concept also, you'll be amazed how many trades you can make. And this is just pure price based trading. Alright, yeah, I like I said, this tutorial was very small. What we take away from this tutorial is that the most important thing is stage analysis. You need to know in which stage the market is currently, whether it is in accumulation, distribution, in trending phases. Now I've given you a lot of insight into how you can know that. You can know that by profile shapes, by the kind of profile openings you can have, by kind of looking at where the market is with respect to high volume, low volume areas, and also by overall analysis of what is happening within a profile, who is in control, what is going on. Alright, now moving forward, what we are going to do is we are going to discuss in detail about how to form a framework to analyze all of this. In between there are 2-3 tutorials that are left. I think they will cover some of these topics much in depth, along with some new information, and then we will come to the framework part, where I'll just give you my framework of how I look at the market through market profile. Let me remind you, I don't use market profile for intraday trading. I'm not an intraday trader. I use market profile to see what the market is doing in the present frame, and then I use it as a standalone system. Sometimes it's not a system, but yes, you can set up some rules, but most of the times I combine it with my other technical system. Okay, it helps you tremendously into what is going on in the market. Okay, so in the next tutorial we'll again begin with something new, and basically we'll take these topics into more depth, and look into how eventually we get to a framework, and then look at some very detailed examples. Okay, see you guys.